Hi guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about whether or not you should adjust your discount rate in today's market. That discount rate, by the way, we call the minimum acceptable rate of return. Let's see if we should change it. So it's no secret, we're faced with a lot of economic uncertainty right now. We're seeing record inflation. The Federal Reserve is aggressively raising interest rates to try to stabilize that inflation. We've got low unemployment. People are still buying stuff. We got high interest rates are starting to kick in to sour the economy. We've got mortgage rates doubling. Stock market's going down. Jobless claims are starting to go up. What is happening? So regardless, though, of what this economy is doing, Rule 1 investors have an investment strategy we should stick to. We can stick to it and buy wonderful businesses at fabulously discounted prices, and that is going to make you rich. However, there are times when you might need to think about the discount rate and factor in current economic risks, and that's what a lot of people do on Wall Street. They go out there and they adjust their discount rate for the risks going on in the market. So what's a discount rate? Let's just dive into that. In my view, what a discount rate is simply the minimum acceptable rate of return you're willing to get year after year. How much do you want to make on whatever it is you're buying? That's the discount rate. Now you can get all kinds of MBA answers to this thing, but that'll do the job for you pretty good. And the rate that I use, the discount rate that I use, is 15%. Now 15% relative to this market in the last 10, 15 years is an extremely high discount rate. It basically says that whatever price I buy this stock at, I need to get a rate of return of at least 15% compounded. And that means if I look out and say that, 10 years from now, I should be able to sell this stock for, let's say, $100. And if I'm requiring a 15% per year rate of return, I know immediately I've got to pay no more than $25 for that company. Now, the reason for that is because a 15% return will double my money in 5 years. 15% doubles your money in 5 years. Do the math, all right? That means that in 10 years, it should double twice. So if I buy the stock for $25, in 5 years, if it doubles at 15%, I'll have $50. And in 10 years, I'll have another 50, or a total of 100. So what that means is a real easy way to think about this, if you use my discount rate, is you take the value of that business out 10 years out, whatever you think it'll be 10 years from now, and simply divide it by 4. And that tells you what is the maximum amount of money you would want to pay for that company. Now, of course, you guys know who've been studying Rule 1 with us, that we then further discount that by cutting that number in half. So we call the number that you arrive at when you divide by 4 to the price it's going to be at in 10 years. Let's say in this case, we think it's going to be 100. So we divide by 4. So we're looking to pay no more than $25. That's the sticker price of the company. That's what it's worth. That's the intrinsic value. Now, we don't want to pay intrinsic value because we could be wrong. We could make a mistake. So we're going to cut that in half, and that becomes our margin of safety. Therefore, the discount rate that we use is not just 15%. It's massively larger than 15%. Now, why would you want to change that? Well, there are going to be companies out there that simply are never on sale under that kind of condition, unless there's some kind of gigantic economic meltdown. But you know what? I would rather wait and be patient and just hold on to that big, huge discount rate, such that when I buy something, it's very likely to be very much on sale. So I'm going to recommend you guys that we don't mess with discount rates. We don't even think about discount rates. What we think about is, what is the minimum acceptable rate of return that I want to get out of my investments well into the future? Now, what about this related to inflation? Well, remember now, if we're already a discount rate of 15%, that's double the rate of inflation right now already. And then again, we're going to cut that value of the company in half and buy it at half of the intrinsic value. So we've already baked in a tremendous amount of the economic risks that we're facing out there in the future with inflation and all the uncertainty around it. So I feel real comfortable. This is when we're going to do a really good job of figuring out the value of these businesses. So use a standard quote discount rate with a minimum acceptable rate of return. The one we use is 15%. Strongly recommend it. I think you're going to do fine if you do that. All right. Now, I'd love to hear from you guys. Should you adjust your discount rate in today's market? Do you think so? I don't know. Write me a little answer to that one. Leave a comment there. I'll be sure to answer you guys, and we'll follow up. Now, thanks for watching, and go play. Hey guys, if you enjoyed this video and you feel it was valuable in teaching you more about adjusting your discount rate given today's market, hit the like button and share this with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.